Governor Bailey, thank you so much for speaking to Bloomberg. GDP
Pleasure.
falling 14%. You may expand monetary stimulus. Why not do it today?
Well, we've got obviously a very rapid and expansion of monetary stimulus that we've already put in place. So we've got a lot going on. So we've already got a lot that's happened, and we've got actually quite a long way to go in terms of what we've announced. If we keep going at the pace that we're going at the moment, we'll be keeping going until probably around early July. So the view we took was that although, as we said in the monetary policy report, that we will obviously continue to support the economy consistent with the inflation target, we're going to look at the news that's going to come out over the next month or so. And we may get some important news. We're expecting some important news in terms of how the government is thinking about the lifting of restrictions, and we'll take that into account, as we think about what to do next. So we've got some time and some room in that respect, but we're very clear that we're going to keep going in terms of what we're already doing.
Did you discuss or consider open-ended QE plan?
Well, I think the distinction between a quotes open-ended QE plan and what we're doing, I wouldn't overdraw it. We've made a very strong commitment. This is more and faster than the Bank of England has ever done before, and we will go on, assessing what needs to be done. So I don't want to overdraw that distinction.
But is it something that's actually dependent on the length of the pandemic? Is that how markets should see it?
Well, it's dependent on how obviously, first of all, you're right on how the pandemic evolves. It's dependent, obviously, on the public health responses to that, because, of course, a key determinant of the path of the economy has been the necessary public health measures. So, yes, it's very dependent on that.
So what could you do in June?
Well, we could do more QE, for instance. But we're keeping all options open. I mean, I'm very clear on that. We're keeping more options open. Two of my colleagues on the committee voted to do more QE now. Other members of the committee thought that it was a sensible decision to take in our next meeting, when we may have some more information.
Are we any closer to negative rates, or is that just not an option right now?
Well, I don't think we're not ruling anything out at the moment, because it would be unwise of us to rule anything out in terms of responses. So I don't want to say we're nearer to negative rates, but we're not ruling anything out.
Under what circumstances would we get negative rates?
I think that the committee has got a long way to go in terms of discussing the negative rate question, were it to think that that was a sensible thing to do. It's a complicated question. You have to view it, I think, in the context of the times, also in the context of the financial structure we have, how the financial system works, and what will be the consequences of it. So I just want to caution, we're nowhere near concluding in that respect.
So you assume a recovery in 2021. Why are you more optimistic than the ECB?
Well, again, we're all using scenarios, and I want to be quite clear that I think all of us are, finding that there's a much bigger sort of gap between the judgments and decisions we're having to take and the scenarios we're using, which is, by the way, why for the first time, really, in any inflation report, monetary policy report, we haven't published a forecast as such. So these are very much scenarios to guide us. I was looking at the scenarios the ECB published earlier this week, and actually you can cite our world economy scenario that underpins our forecast. It very much sits, frankly, in pretty much the middle ground of what the ECB published.
But what does it do to forecast, or what does it do to your thinking if we have a slowdown that is not as severe this year, but then we have a much worse number in 2021? If there's a second lockdown, for example.
Yes. Well, we would obviously have to reevaluate, and there would be a new scenario that we would use in that case. We've got a gradual lifting of the lockdown in the third quarter of this year. We've got a further assumption that actually people in a sense, I put this in quotes, voluntarily are then quite cautious about the way they re-engage. So we've got a degree of caution that pushes the path of our recovery out into next year. Obviously, if the whole disease then evolves in a different way, we will have to just come back to that.
I know it's also on the assumption that the government schemes kind of, run out gradually starting in June. Have you had any discussions with the Chancellor to extend that?
Well, those are decisions for the Chancellor, of course. Chancellor and I discuss regularly. We're in very close contact. And let me say, I think these schemes are working. So one of the important reasons why we've got a pretty rapid recovery in our scenario, and one of the reasons why we don't get long-term damage in our scenario, is that we think particularly the furloughing scheme is working and it will do its job. And the job it will do is to enable people to come back into the labour force back into full-time work, productive work much more quickly, and that will be a real success. I mean, there's a real success in there. So, yeah, we're very positive about that.
But so are you assuming that 80% of people furloughed keep their jobs in 10 months, or it could be? I mean, it could be a much worse, right? Many more people that are furloughed could lose their jobs permanently.
Well, there is obviously you're right to point to that. There's an uncertain element about the sort of the exit path. We think most people will come back in, and the reason for that, of course, is that there's a whole set of other measures that are being taken to support companies, so that they're able to come back again and to resume their business. So these things have to fit together. So that's why we think the furloughing scheme is going to work. Now, it's an interesting judgment as to what will be the set of companies that will struggle, because the world will change. They may have been over-indebted before the COVID problem happened, and this will seriously affect them. That's a judgment that will obviously evolve as time goes by. But we think that for the most part, people with these schemes in place will come back.
Do you worry about inflation, and inflation suddenly come back up?
Well, you may have seen the path of inflation in the scenario that we have. Actually, in the next year, we think inflation is going to drop quite rapidly, and you may have seen in the scenario we've got inflation going down pretty much towards zero. And of course, the big reason for that is that there's been a very substantial drop in oil prices, which obviously feeds through very quickly. And then we've got a gradual recovery as activity in the economy resumes, as the output gap starts to therefore revert back. But I would caution, there's a lot of people writing about, are we going to get high inflation? No, we don't see that happening.
But what's your biggest concern in this? Is it trying to get out of the, to exit all this extra stimulus? If you look at your top three things that you worry about longer term, what are they? Well,
I think in the medium and longer term, obviously, first of all, the economy coming back into full life again and making sure we get that recovery. I think secondly, what sometimes gets called scarring, how much of a longer term effect is it, and how much is it going to reduce productive capacity? Are we going to get higher unemployment that persists? I mean, that's a concern. We don't think there'll be a huge amount of that, but obviously, again, it's something we'll be looking at very carefully. And those are the things that are most on my mind. I think the inflation profile is pretty low at the moment. Frankly, it's not something that it's something that we're looking at very carefully, because obviously there's going to have to be a recovery of inflation back towards the target, but not high inflation.
There's a lot of trade tensions between the U.S. and China that are back at the forefront. If it goes into a trade war, what would be the impact on the UK economy?
Well, I think any trade war is going to have a bad impact. As you remember, I mean, prior to any of the COVID problems coming along, it was one of the major risks to the world economy that there was going to be disruption to trade. I think that risk lifted in the first month or two of this year. It all seems like ancient history now, actually. I think any resumption of trade restrictions which are unreasonably motivated by the issues that we're dealing with at the moment, I think would obviously be detrimental. I'm a very strong believer in free trade. It has to work to meet the needs of the people. There are a new set of issues around at the moment about health and security. We've got to deal with those issues, but I would just emphasize any unnecessary restrictions on free trade are bad for the world economy.
What does 2021 look like if we have no extension for the transition, for Brexit, so no Brexit deal, and a US-China trade war?
Well, what we're assuming in our projections and in our scenario is what we always do, which is that we assume stated government policies. Stated government policy is that there will be a trade deal. There will be a trade deal with the EU. There will not be an extension. That's what we're assuming. That's what the government is very committed to doing. Obviously, as we know that the US trade negotiations have just got underway. Again, I'm a strong believer in free trade, so I'm very hopeful and strongly supportive of those processes, and we'll just have to see where they get to then.
Is there still a risk that this crisis becomes a financial crisis?
Well, obviously, if you go back to the middle and the second half of March, we were looking at very, very severely difficult conditions. I mean, very disorderly markets. We and the other central banks had to step in. We've all stepped in very big ways. A lot of firepower has been brought to bear. It's been very closely coordinated between the central banks, and it has had an effect. But I would say this, that I think we are still on very high alert, because I'll give you the example of what happened in the oil price the other day, in the West Texas price. I mean, I got home one evening to find the oil price was negative. You just think, how can this be? Now, interestingly, of course, as you know, you'll have talked a lot about this, there are all sorts of stories you can tell about how this is idiosyncratic, all sorts of things about Cushing, Oklahoma, and so on. But I would just caution that, you know, history, and I've seen a lot of these, bears out. Yes, we can always tell stories, but to dismiss this as just a sort of slightly odd idiosyncrasy, I think there is always one thing you have to have in mind. Is this a sort of canary in the coal mine, which says, actually, there are wider, you know, fragilities here that we have to be considered, and that's certainly our view. It's not because we have a particularly different story about the oil story. It's because it points to the fact that we've still got fragile markets.
But is that indicative of something bad in the financial crisis, or is it a much worse economy worldwide? What does that, you know?
Well, I think it's actually both. So obviously it points to the fact that there is a supply-demand imbalance in the oil market. And that's unsurprising in a way given what's gone on, but it points to obviously a fragility in the economic sense. But it also points to the fact that there are fragilities in the market, in financial markets. We've got a number of things that we've seen during the last few months, which we're going to have to come back to as authorities, as central banks and as governments, and say, you know, what do we learn from these fragilities in markets that we need to deal with? Because there are things we can point to which frankly, you know, we're not going to be comfortable to just say, we're through this, we're going to go back to normal. There will be issues to deal with.
Do you think WTI can go further negative, or, you know, more negative in the next couple of months? And is there anything that central banks can do together to try and keep an eye on the markets?
Well, I think the thing that we're all doing there as market regulators is to understand what the particular underlying structural causes of this. Now, some of it's obviously in the way the contracts are constructed, some of it's in the storage capacity system, but we are looking very closely at how those contracts work, how the limits in those contracts work, and what it's causing in terms of trading. And we've all seen the stories about, you know, particular sort of trading concentrations in those markets. You know, are the positions too concentrated in those markets, such as when they shift, they create too much volatility? And again, those are questions that are very much on the agenda, and we're going to have to keep coming back to, I think, and say, you know, are we content and comfortable with, you know, those sorts of situations?
Is there anything else in the markets that you would worry about? Is it liquidity somewhere else?
Well, I think we saw very, you know, severely strained liquidity conditions in markets, which of course went through into core markets. I mean, this went transmitted through into the US Treasury market, which is a core market. So yes on that. I should say as you know, one of my favorite subjects, I'm going to have to say something about LIBOR at this point. I mean, we have seen very elevated LIBOR settings, and frankly, we've also seen those elevated LIBOR settings based on very little actual traded, quoted activity. There's a lot of what I'm going to call best judgment in there. And again, I always say this, as you know, I'm not saying that there's anything wrong, there's any misconduct going on, but it just points again to the fragility of this whole system. And the fact that it's fed through into the real cost. As the central banks have pushed down on rates, we've found the LIBOR premium going up on the basis of very little actual activity.
Is there anything that central banks can do today to try and limit that danger?
Well, I think we get on with the LIBOR transition. I think, again, it points to the fact that this is a structural feature of the market that just does not look sustainable.
Governor, thank you so much.
Well, thank you. It's great to talk to you.